Welcome back to International Financial Management. We started the fourth week with the explanation of exchange rate quotations. Therefore, everything we discussed in the last lecture, that is, direct and indirect quotes, bid and ask rates, and American and European terms, will help us understand today's topic in a better way because today's lecture is based on those concepts. Till now, we have discussed how exchange rate quotations are given in the foreign market. But many times, a direct exchange rate between two currencies is not available in the market. In such cases, we calculate the exchange rate through a third common currency, and this is known as a cross rate. Let us discuss it in details. Let us start with the definition first. A cross rate or a cross currency rate is used when you want to find the exchange rate between two currencies that are not directly quoted against each other. Suppose you want the exchange rate between currency A and currency B, but the market does not directly quote it. And if both currency A and currency B are quoted against currency C, then currency C becomes the common currency used to derive the cross rate. For example, 1 unit of currency A is equal to 2 units of currency C, and 1 unit of currency B is equal to 4 units of currency C. Then 1 unit of currency B is equal to 2 units of currency A, or 1 unit of currency A is equal to 0.5 units of currency B. So even if the market does not directly quote currency A against currency B, the exchange rate can still be calculated through currency C. The third currency C is known as the bridge currency. It is used when a direct exchange rate between currency A and currency B is not available. Usually, the US dollar acts as a bridge currency because most currencies are commonly quoted against it. Now, here is the key point in the definition. Cross rates are derived. They are not directly observed in the market with the same liquidity and availability as dollar pairs. They are calculated using the dollar as the bridge from the two rates that are directly quoted and liquid: currency A against USD and currency B against USD. This is why the topic is called cross currency. You are crossing from one currency to another, passing through the dollar as the connecting link. The global forex market has organized itself around the US dollar. Nearly 9 out of every 10 forex deals worldwide involve the dollar on one side. According to Bank of International Settlement, as of 2025, the US dollars appears in 89.2% of all global forex transactions. Almost every currency in the world has a direct, highly liquid trading pair with the USD. It can be USD INR, USD Yen, or Euro USD. These pairs are traded in enormous volumes every second of the trading day by thousands of dealers across the globe. The spreads on these pairs are extremely tight. The prices are almost perfectly up to the date. This is why the dollar is called the vehicle currency. It is the vehicle through which any two currencies can be exchanged. And this dominance of dollar has persisted for decades, reinforced by the depth and liquidity of US financial markets, the global use of the dollar in trade invoicing, and the dollar's status as the world's primary reserve currency. Now let us go deeper and understand why cross rates need to be derived rather than being directly quoted in the market. This is an important structural point. Direct bilateral quotes between two non-dollar currencies, say between Indian rupee and Japanese yen, are not available with the same liquidity. Very few dealers specialize in INR Japanese yen pair directly. The volume is too thin, the information is scattered, and the spreads, if a direct quote is available at all, are very wide. So the market solved this problem elegantly. Instead of trying to maintain a liquid bilateral market for every possible currency pair, which would require an astronomical number of pairs, it maintains liquid USD pairs for every currency and derives all cross rates from those. The cross rate also can be calculated through any common third currency, but in practice, the US dollar is most commonly used because it is the dominant international trading and reserve currency. Let me now show you the bridge concept visually, because this visual logic is the foundation of every cross rate calculation you will ever do. Imagine three boxes on a slide. On the left is Indian rupee, on the right is euro, and in the middle at the top connecting the two is USD, that is the USD dollar. Two arrows come down from USD, one arrow goes to Indian rupee. So USD Indian rupee is equal to 84.50, while Euro USD is equal to 1.0850. This rate has Euro as the base, USD as the price, and at the bottom, what we want to find in the direct arrow, that is from Euro to Indian rupee, is what will be the rate of Euro per INR. This is the cross rate we need to derive. The derivation is going to be Euro upon INR is equal to Euro into USD upon INR, which gives us 1.0850 into 84.50, that is rupees 91.68 per euro, which is the cross rate. Now let me explain you with help of the example. Now let us understand cross currency in an easy manner, right? And we will be calculating this cross currency through USD. Fine. So here let us talk about the master formula. The master formula given is A by C equal to A by B into B by C, where USD is the bridge currency. We can also call it as vehicle currency. Now let us talk about case A. This is the case of multiplication. Now we will do it with the help of an example. Now here the euro, as we have done in the previous example, euro and USD rate was how much? 1.0850, while the USD and INR rate is 84.50. Now if we want to know the euro INR rate, this we can get easily by euro divided by USD into USD divided by euro. This gives us as 1.0850 into 84.50. So what is the euro INR rate? This is equal to 91.68, right? That means we have to spend 91 rupees 68 paisa for buying 1 euro. Now next is the case 2, that is case B, we can say. This is of divide. Now in this case, both rates have USD as base. Now what is going to be the formula here? Here the formula is going to be A by C is equal to USD by C divided by USD by A. So, here let us have a formula. Suppose USD upon INR is equal to 84.50 and USD upon AD is equal to 3.6725. So, if we have to calculate AED upon INR, it is going to be USD upon INR divided by USD upon AED. So, this comes out to be 84.50 divided by 3.6725. So, the rate becomes as 23.01. Now, let us define the two forms in which a cross rate can be expressed, and these should feel familiar because the same direct indirect distinction applies to regular exchange rate. Direct cross rate refers the price of one unit of foreign currency expressed in the domestic currency. The foreign currency is the base fixed at 1 unit, domestic currency is the price. From Indian perspective, euro upon INR is equal to 91.68. This is a direct cross rate. 1 euro cost rupees 91.68. Euro is the foreign cross currency and the base. INR is the domestic currency and the price. This is the more commonly used form in India because Indian businesses, banker and importers think in rupees. How many rupees does 1 euro cost is the natural question. The direct cross rate answers it directly. Indirect cross rate refers the price of 1 unit of domestic currency expressed in foreign cross currency. Now, the domestic currency, that is the rupee, is the base, and the foreign currency, which is euro, is the price. For India, INR upon euro is equal to 0.010907. That is, 1 Indian rupee buys 0.0109 euros, or equivalently 1 rupee buys about 1.09 euro cents. How is it derived? Simply taking the reciprocal of the direct rate, that is 1 divided by 91.68, gives us this amount. This is the summary comparison table of differences between direct and indirect quotes, which we have discussed earlier. Direct cross rate into indirect cross rate is equal to 1. They are always perfect reciprocals of each other. So far, we have been computing cross rates using single mid rates, one number for each pair. But in real market, as we have established in our last lecture, every rate is a two-way quote, a bid and an ask. The bid is what the bank pays to buy the base currency. The ask is what the bank charges to sell the base currency. Cross rate must also be computed as a two-way quote with a bid and an ask. Before we move to the numericals, I want to highlight important consequence of the bid-ask cross rate rule. Cross rate spreads are always wider than the spreads of the individual component rates. Think about why. The bank is compounding its margin across two pairs. It applies its spread on the first pair and its spread on the second pair. And both spreads work in the bank's favor simultaneously. The result is a cross spread, that is approximately the sum of the two component spread. if the Euro USD spread is say $0.002 and the USD INR spread is 0.20 rupees, the Euro INR cross spread will be wider than either of these individually. The practical implication is that if you need to do a cross currency transactions, you will always pay a wider spread than for a direct dollar transactions. If you are a business that frequently converts euro to rupees, you are paying for two layers of intermediation, the euro dollar layer and the dollar rupee layer simultaneously. Now let's understand it with the question. In this question, we have British pound USD rates, that is the bid ask rate, where this is the bid price, this is the bid price, and this is the ask price. We also have another currency pair which is USD Japanese yen. Now this is the bid price and this is the ask price. Now if we have to calculate the British pound by yen bid and ask price, then the formula is going to be British pound by Japanese yen bid, which is going to be the bid price of GBP Japanese yen into the bid price. This is the bid price. Similarly, we have USD Japanese yen and this is also the bid price. Now we'll put the values in the formula and it comes out to be 1.2640 into 149.60, which gives us 189.10. Then if we go for GBP Japanese yen ask price, then we will write down GBP USD ask price into USD Japanese yen ask price. Now this we are going to multiply these ask price together and what do we get? 1.2660 into 149.80. This gives us 189.65. Now what does it mean? That it means that if we have to see the British pound and Japanese yen bid ask price, then it is going to be 189.10 upon 189.65. So this is the bid price of this pair of currency and this is the ask price. So what is going to be the spread? The spread is going to be 189.65 minus 189.10, which gives us a 0.55 Japanese yen per British pound. Recall case B when both given rates have USD as the base, that is USD divided by A, that is the A currency, and USD divided by C, which is the C currency. We compute the cross rate by dividing one rate by the other. The formula is A by C is equal to USD divided by C into USD divided by A. But when we have bid and ask rates, which combination do we use for the cross bid and which for the cross ask? So in this, cross bid is equal to USD by C bid divided by USD by A ask, or cross ask is equal to USD by C ask divided by USD by A bid. Now let us understand it with help of an example. We have been given rates dollar Indian rupee, which is 84.40 divided by 84.60, and we have dollar dinar, which is 3.6700 divided by 3.6750. Now this is the bid rate, this is ask, similarly this is bid, and this is ask. Now we have to find out the dirham rupee buying and selling cross rate. Now bank sells dirham. So what we will do? We will do USD INR divided by USD AED. So here it is going to be the ask rate, and here it is going to be the bid rate. Hence we will write here as 84.60 divided by 3.6700, which gives us 23.051. Now we will also try to find out, this is the cross selling rate, and we will find out cross buying rate. For cross buying rate, we will bank buys dirham. Now this is equal to USD upon INR bid rate divided by USD upon dirham ask rate. This comes out to be 84.40 divided by 3.6750, which gives us 22.965. Now if we have to quote dirham and Indian rupee bid ask price, so this is going to be 22.965 divided by 23.051. Now this is the bid price and this is the ask price. Now what is the spread? Spread is equal to the ask price, which is 23.051 minus the bid price, which is 22.965. So the spread is equal to 0.086. We now arrive at a very important conceptual topic, which is triangular arbitrage. Let me give you the definition. Triangular arbitrage is a riskless profit strategy that exploits an inconsistency between three currency quotes, specifically when the cross rate that is quoted directly in the market differs from the cross rate that can be derived theoretically using the USD as the bridge. The condition for arbitrage is quoted cross currency should not be equal to Euro per USD into USD per INR or the application derivation formula. If they are equal, the market is consistent and no arbitrage exists. If they differ, profit is available. If the quoted cross rate is higher than derived, the cross currency is overpriced in market and we get profit by selling it. If the quoted cross rate is lower than derived, the cross currency is underpriced and we get profit by buying it. Start with the sum of money in A, say US dollar, convert A to B, B to C and back to A using three quoted rates in sequence. If the ending amount in currency A is greater than the starting amount, an arbitrage profit exists. If it equals the starting amount, no arbitrage. If it is less, you went into the wrong direction. Reverse the sequence. The profit comes from the circular conversion. You exploit the inconsistency in the triangle of rates and end up with more currency than you started with, without taking any directional risk on the exchange rates. Before we do the numerical, let me make a critical point about what triangular arbitrage does in the real market. In modern electronic markets, algorithmic trading system detect and eliminate triangular arbitrage opportunities within microseconds. Dedicated arbitrage algorithms scan thousands of currency pairs simultaneously, identify any inconsistency, execute the circular trade instantly, and the act of trading immediately pushes prices back into the alignment. As a result, in well-functioning market, genuine trading arbitrage opportunities are essentially non-existent in practice. They last for fractions of second before they vanish. So, why do we study it? Two reasons. First, understanding triangular arbitrage helps you verify whether a quoted cross rate is fair or mispriced. If you are a corporate treasurer and a bank quotes you euro by INR is equal to 92.50 when the derived rate is 91.68, you know the bank's quote is significantly above fair value. You can challenge it or go to another dealer. Second, triangular arbitrage enforces the law of one price across all currencies. The reason euro by INR in the market stays consistent with euro USD into USD INR is precisely because arbitrageurs would immediately exploit any deviation. Studying arbitrage tells you why markets are efficient, not just they are. So basically, triangular arbitrage is your fairness verification tool. Now, suppose you have 1 lakh dollars and you are provided with the following exchange rate: the euro USD is equal to 0.8631, while euro British pound is equal to 1.46 and USD British pound is equal to 1.6939. So you have three exchange rates. Fine. Now we are going to calculate implied cross rate, and the currency that we are going to use here is euro upon British pound. Now this will be equal to USD British pound into euro USD. So this comes out to be 1.6939 if I put the values in it, 0.8631. This gives us 1.4620. Now see, the cross rate given to us was 1.46, but the implied cross rate is 1.4620. That is, it is higher. This implied one is higher than the given one, right? Now, since we have come to know that the implied rate is different from the given rate, now we will take a particular path to find out whether the triangular arbitrage exists and what is going to be the path for it. Fine. So what we are going to do, we are starting with dollars because we have dollar 1 lakh rupees. We will convert it into British pound. Then we will convert this British pound into euro, and then again we will convert them into dollars. And we will see the difference, what we get, in the end from what we have started in the beginning. So we have 1 lakh dollars with us. Now we are going to sell dollars to buy British pound, and what we are going to do, we will multiply with this particular figure and we get 1,69,390 British pound. Now these British pounds will be sold and we will exchange these British pounds for euro. So what we are going to do here, we will take another rate which is this one, right, and here we will divide 1,69,390 by 1.4600. We will get euro 1,16,020. Now these euros we will again use to buy, these euros we will use to buy dollars now, and what, how we are going to do, we will take this particular rate and here we will multiply 1,16,020.55 into 0.8631 and we will get a figure in dollars which is 1,137.33. So we started with how much? We started with 1 lakh dollars, right? And after going through this particular arbitrage, we have in the end received how many dollars? 1,137.33 dollars. That means 137.33 dollars is the profit, which is our arbitrage profit. Now had we used another path like from dollar, we would have converted dollar to euro, then to British pound and then to dollar, fine. Then the dollars that we receive in the end would be different. And here if we, you can calculate for yourself, the dollars here are going to be 99,862.85. That means we started with 1 lakh dollars and now in the end if we take this particular path, we will receive how many dollars? 99,862. So this gives us a loss of $137.15. So obviously we are not going to use this particular path, we will use this path in order to fetch profit. So in today's lecture we discussed what the cross rate is and how it works, and we closed with triangular arbitrage, the elegant enforcement mechanism that keeps all cross rates consistent with each other. It is the market's self-correcting immune system. With cross rates mastered, you know how a complete toolkit for every exchange rate quotation scenario. Now I will like to end this lecture here. Thank you for now. See you in the next lecture.